on this stage, we are going to look at the evolution of DeFi. With the whole industry maturing, UX rapidly improving, real-world assets moving on-chain, the opportunity for DeFi has never been bigger. And I think we should bring onto stage some of the heavyweights in the industry to discuss this topic. So please join me in welcoming founder of Bankless, David Hoffman, founder of Aave and CEO of Aave Labs, Stani Kulichov, and co-founder of 1inch, Anton Bukov, and founder of Off-Chain Labs, Stephen Goldfeder. Thank you, guys.
Hello, everyone. How's everyone doing? While we get the chairs up, we can begin with the first question. So there are just a handful of buzzwords being thrown around in 2025. Stablecoins, institutions are here, like kind of all these different metas that we've all been tumbling around over the last, it's called 18 months or so. I kind of want to just pick each of your individual brains about how the current market environment has dictated or inspired some of your current strategies. So what are the current needs in the market, and what are you uniquely doing in the last 12 months, 18 months to really answer to the current needs of the market? So kind of placing us in time in the arc of DeFi. Stani, I'll start with you.
Yeah, I think there's at least two interesting trends. So one is after the Black Friday, we realized that again, how resilient decentralized finance is at the moment. So I think DeFi has been here for over half a decade, a little bit more, and every single kind of market stress really proves how decentralized finance can be extremely resilient and a financial infrastructure that can be scaled. As of today, for example, Aave has 50-60 billion worth of net deposits, 15 billion in stable coins, and 30 billion in borrow volume, and it just showcases the scale of where DeFi is today. And that resiliency is something that doesn't go unnoticed. I think now we're also entering into a phase of embedded DeFi where we'll see companies and fintechs and traditional finance actually looking into DeFi and trying to figure out how this could actually benefit their businesses by providing alternative yield sources, alternative utility, and also giving a response to a macro conditions where interest rate markets are going down at the moment by Fed, and probably will continue having rate cuts over the next 18 months. The another trend is obviously seeing more tokenized assets and seeing actually using the same DeFi infrastructure we built that is resilient in these native crypto assets and reapplying to traditional crypto assets. And that's what we're doing with the Aave Horizon, where you can lend stablecoins against tokenized assets. And last kind of trend that I've been extremely excited about is making DeFi more accessible to everyone. So now that DeFi has been a very kind of in the user bases of early adopters, technical folks, we want to find out how do you go direct to the consumer without compromising the self-hosted or self-custodial experience, but making it as easy as possible, bringing funds from your bank accounts and depositing into DeFi. And I think that's something I'm really passionate about, and especially in the coming year, going to work on quite a lot.
Anton, yeah, just let me throw you the question one more time. What are the current needs that you are feeling in the current market environment, and how are you leading 1inch to answer to what the market needs in the moment?
Yeah, I heard from a few people that DeFi is dead. I wouldn't agree to that. I opened some Dune analytics.
Who said that?
Yeah, I don't know who says that.
It was in a different place. Here are only good guys. Okay, so I opened Dune dashboards and checked out, and I actually saw that in terms of activity of DeFi, number of wallets, number of swaps, number of volumes, nowadays it's higher than a previous bull run. So I'm not sure what means that here. But I think that DeFi became a little bit more boring because, yeah, we have some technologies like they were invented, some of them were invented 5, 7 years ago. Some of them were invented like 2 years ago. It's pretty new ones, but yeah, I was always making talks about DeFi, and I was promising people that DeFi should be amazing, and I was living in the future when I was telling that. So I was like so boring to wait when someone would innovate. So we started to innovate from 1 inch. So recently, like 2 days ago, we announced our new approach to liquidity. We called it 1 inch Aqua. It's the very first shared liquidity protocol. This is a solution for liquidity providers, which lets them provide liquidity right from their wallet. And it does not lock liquidity, and it lets you reuse the same liquidity among multiple AMMs. And this is a layer protocol. This means that anyone could build any strategies on top, any AMMs. And those who build AMMs, they don't need to compete with TVL anymore. So we tried to redefine liquidity provision completely, taking a look like from a very different perspective to increase utilization, to increase yield returns for liquidity providers, and make their liquidity DeFi unlocked. Because when you lock your assets in the pools, they are DeFi disabled. This means that you can't do anything without those tokens. They can only be transferred with those pools during swaps. But if you have assets on your wallet, you could use them in DeFi manner. You could vote in DAO. You could leverage your liquidity with a money market like Aave. Just come to Aave and you could turn your 1K or 10K, you could turn it to 20, 30K of liquidity and maybe 20K debt. Yeah, it will be on your wallet, this is fine, but you could make those A tokens work for you in AMM right from your balance. So yeah, I really hope this would change the landscape of DeFi.
Stephen, Arbitrum had one of the biggest wins of 2025 when it comes to just the aligning with the current narrative of the time, with just institutions coming in a very meaningful way on chain, taking Robinhood and actually giving it a chain. I can only assume that there are more conversations that we are not yet privy to yet. Maybe you could talk about some of the needs of these people, Robinhood and Robinhood-like companies. What do they need, and how are you bending Arbitrum to kind of fit their needs?
I think actually it's exactly what you said. It's bending Arbitrum to fit their needs, and it's the realization when in the age of institutions, we can't come anymore and like dictate what you need because there are so many complex inputs that go into that. That's regulatory, that's region-based, that's also just, you know, you have these institutions, some of which have been around for like 100+ years, particularly on the asset management side, and there's just a lot of process that you have to go through. And to think that we're going to come, you know, with our shorts and t-shirts and say, hey, no, this is how you do it, like that's honestly just making a very, very big mistake, and you have to actually bend to them. And the key word that we've leaned into is customizability, and understanding that the needs of BlackRock might not be the same as the needs of Robinhood. And by the way, the needs of Robinhood is probably not the same as the leading fintech here in Argentina, because you have different regions, different users, different regulators, and we have to basically give you the most customizable platform that actually works for you. In the case of Robinhood, I actually think this is one of the core reasons why they chose Arbitrum. Arbitrum is in a very unique position because we have both a top public chain in Arbitrum 1, one of the most liquid chains, the most liquid layer 2, but also we have one of the top or the top most adopted blockchain stack in Arbitrum Orbit. And you can go back and forth between these two, and we're able to actually give you customizable solutions. So when we get into a room with someone, I don't say, you should build a chain. There are competitors that say to everyone, you should build a chain. There are competitors like Solana that will say to everyone, you definitely should not build a chain. We'll say, who are you? What are your needs? For some of you, it makes sense to build a chain. For some of you, it doesn't. And actually, you can go back and forth between these. And that's what Robinhood did. In June, when they launched their equities on Arbitrum One. They launched about 200 equities then. They've expanded it greatly. They're now over 700 equities launched in Arbitrum One. And they're building their own chain. And because it's all in one ecosystem with one technical product, they can go back and forth between the two of them seamlessly. But the idea is, in every conversation, we just come with a menu of options, and what we say is Arbitrum everywhere. No matter where you are, we can meet you. Whether you need a highly liquid chain in Arbitrum One, we can meet you there. Whether you need your own blockchain in Arbitrum Orbit, we can meet you there and customize it for you. And by the way, even if you don't want your own chain and don't want an Arbitrum One chain, Arbitrum can probably help you, and Hyperliquid is a fantastic example there. They have their own chain, they're not an Arbitrum, yet they source all of their liquidity from Arbitrum. So Arbitrum can really be a solution for you across the gamut of crypto, but the key is listening to what you need, not telling you what you need, and giving you the tools to customize the technology to those business needs.
Are there any vectors of customizability that have cropped up to be more relevant than others? I want to give an anecdote here where Stripe's Tempo chain has one little technical feature in it, and it has a memo. It has a memo field, which is a crazy small marginal change, but it's something that Stripe and all the banks that might use it truly needs, and all it is a memo field. Are there any features like this or vectors of customizability that have really shown themselves to be more relevant than others as you have talked to some of these institutions?
Yes, the largest two that come up are number one, KYC/compliance, which is when we operate Arbitrum One as a public, open, permissionless chain, but some institutions cannot do that. And again, for us to come and say, no, that's against our values, would be making a big mistake because we can't, I'd rather you be at 90% or 80% than be at 0 or 100. It's not binary.
Plus, that's what Arbitrum One is for.
Exactly. There is a public, open, incredibly neutral chain, and we have opinionated block space for the things you need to customize that are different than that. If everyone needed the exact same vanilla architecture, we wouldn't need all of these clones of the chain. And the second one that's, I would say, a big theme today is privacy. And it's a different, actually, notion of privacy than we've had historically. The historic notion of privacy that we thought about, there were actually two. There were initially public blockchains and private blockchains where there was just a set of people, consortium chains that knew everything, but no privacy within the set. But the more recent notion of privacy was Zcash privacy, which is everything's private from anyone. But actually, the most relevant notion of privacy that we're seeing requested today is kind of in between. It's like your bank account. I'm fine. I know that Chase or Citibank, they have everything on me. They know where I live. They know how much money I have. They know my name. They can get me. But I just don't want the next customer at Chase actually being able to access my information as well. And that's actually the most popular notion of privacy that institutions are requesting, which is the operator can access, but just make sure that users are segmented and the public is segmented. And this actually often helps with their regulatory needs as well, so they can have the information to present to a regulator, but users have the experience. They know that when I pay something in my bank account, my neighbor can't snoop on those details.
Anton?
Yeah, let me contribute to this thing. I like what you said, Steven, about the values, about KYC and everything. But I think we could see this from different perspective, that actually DeFi and those blockchains, they are for financial freedom. And it's actually a freedom for protocols or subset of protocols or subset of users to self-restrict themselves if they think they want it. I mean, we should not deny them to self-restrict themselves because it's freedom. So, different entities, different governments would regulate those DeFi and blockchain stuff differently. Some of them will try to regulate it in a hard way. Some of them will approach it from different side. For sure, those who would merge their economies with a permissionless economy, DeFi, they would benefit the most because they would also merge those economies to each other through DeFi. And as I said, freedom means freedom. It should not restrict subset of users or subset of protocols to self-restrict themselves.
Absolutely.
Stani, there's a few conversations here that's relevant to Aave. Aave, I'm assuming, wants to onboard real-world assets. Real-world assets have their own compliance encumbrances. And then also, institutions also need to have just increased due diligence about who their counterparties are and what the nature of those assets in Aave are. Can you talk a little bit about what you have been building at Aave to, again, kind of in the same vein as my question to Steven, bend Aave to fitting the needs of people that have much more needs than the average crypto individual?
Yeah, I mean, Aave has been successful on the permissionless world and with these like a native crypto assets. But there's a growing trend on actually seeing securities on chain. And Aave as a permissionless infrastructure can be applied to those assets as well. There's obviously some peculiarities that differentiate RWAs. So typically they're permissioned, so transfers are between qualified peers. And the way we structured our approach with these tokenized assets is that the protocol itself is permissionless, works exactly the same way as the main Aave markets, but the permissioning happens on the asset issuer level. So if there is assets that are securities and needs some qualifications, users go to these asset issuers, acquire the securities, and then they can use them as a collateral in Aave to borrow 24/7 liquidity outside of trading hours. And the stablecoin parts, stablecoin supply is permissionless, which gives the suppliers a new type of a risk profile, lending against traditional assets, but doing that on chain. So I personally think that the future, even for securities, is going to be permissionless. I think that's where the world will go, because the network effects, the benefits that comes from pure DeFi is you can't achieve the same effects by putting obstacles and anything between that. But I think Horizon and all these initiatives in the institutional side, whether it's KYC or any sort of permissioning, is actually works like a Trojan horse. So we educate institutions on how DeFi works. They can get their feet wet, start these markets, create utility around tokenized assets that weren't before. Because purely by tokenizing assets, that might not create that much of a value. But at some point they see that, oh, actually, the real business and real economics and the real cost savings are happening on a permissionless world where liquidity can flow extremely well. And at that point, a lot of these floodgates will be opened. And I think at that point, we'll receive a comfort level, not just from institutions, but regulators, that it's actually okay to use a permissionless systems, and there's other tools to mitigate any types of risks that might occur or we see in traditional finance. So I'm really bullish on both of the worlds.
There's the broad question of, are there going to be two different instances of DeFi? Will there be permissionless cypherpunk DeFi, and then will there be a different instance, which is like KYC compliant DeFi? The answer that I heard you just give is that we're mostly sticking to the permissionless cypherpunk version of DeFi, and the compliance comes in at a higher level, at the asset issuance level, and Aave doesn't really need to be really part of the KYC compliance story. That part happens at a higher level, which maybe we get all the KYC compliance encumbrances that we kind of don't really want, but we do get all the assets, and they all kind of ultimately flow down to the same Aave. Is that correct, or do you need to change some of that?
Yeah, and I think we probably will still be in a world where like DeFi is going to be fully permissionless, and maybe the kind of like the edges of DeFi where you have access points, the exchanges of the world, the on-ramps and whatnot, they might do their KYCs when you go from traditional world into the DeFi world, and mitigating the risk of AML and so forth. So that still will exist. But on the architectural level, I think at some point a lot of the institutions will see the power of permissionless DeFi. In the same way as basically they saw the power of public blockchains. The fact that what Arbitrum is doing on the institutional side and with the fintechs couldn't be imagined, for example, two years ago, when a lot of the institutions were pretty much betting on private blockchains that really didn't make sense back then, but like clearly doesn't make sense now, even to institutions. So we're going to move towards the similar direction where the permissionless DeFi is the end game.
Anton, when it comes to aggregation of assets and aggregation of liquidity, we all got exposed to aggregators, I think, in 2020 and 2021 when we were really learning how to all do our token swaps on blockchains. the conversation is different when it's institutional assets and things like securities. Talk to me about what 1inch is doing in this realm. Do you guys again need to bend 1inch to work with securities and more compliant and encumbered assets, or is it something that you just don't actually have to be concerned with?
Yeah, originally we were considering to make a separate version of 1inch, which is more compliant for institutions, but later we get a little bit smarter and understood that institutions will not come with a MetaMask on our website. We're not going to change trillions with their self-custody wallets, which works like that. So yeah, they're more sophisticated players, and they would use it with institutional grade instruments. So they would rather use APIs than front ends. That's why they have to. We have to be compliant with them in terms of certifications, like SOC 2, for example. And yeah, that's what we recently achieved. And yeah, now our APIs are institutions ready, and we are available to work with them, and we are actually actively working and discussing with them and helping them to understand how to shape their appearance, their existence in this model. So yeah, as you said, we started with aggregator. It's actually very interesting that we started with defragmenting liquidity from the taker point of view. But as I said in the beginning, we're launching liquidity protocol, which is making defragmentation of liquidity for liquidity providers, but which is increasingly fragmenting everything for takers. So yeah, this is a bit controversial, but I hope this would make market more efficient. Yeah.
So if I'm hearing you correctly, there's not really much in the smart contracting realm, like down close to the metal, that really needs to be adapted to fit institutions. Institutions just need to learn how to communicate via API, which is their comfort zone, in order to do stuff on chain.
Yeah, I would say we support some additional measures off-chain on our infrastructure. For example, when institutions willing to swap, they are not going to use every liquidity which we can find for them. So they're not execute for the best possible price. They would execute for the best possible price with non-dirty liquidity. This is not the same. So we are also working with many partners to check which liquidity is dirty, which is not, because it's also a spectrum. So yeah, this question is actually much more complicated when we originally looked at it. So we see it as a spectrum of dirtiness, and different different institutions could have different requirements. And yeah, so that's what we're solving for them.
We've all either explicitly or implicitly used the word fragmentation, each of you, and so I want to dive headfirst into that subject. Stani, not terribly long ago, Aave V4, there was an announcement that Aave was being wound down on certain low activity chains. Can you talk about the long-term equilibrium of the number of Aave instances you think that there will be? Will we ultimately collapse down to just a single Aave instance, or do you think there will always be a handful of Aave instances? How do you think this equilibrium levels out?
Yeah, this is a community proposal that is in the Aave governance about adjusting a lot of the risk and reward that comes with some of the networks, and a really short kind of a take of that is that if you think about Aave as a protocol, it always has some sort of risk that is taking into when it's launching a new market, listing assets, and to provide that kind of a facility of lending and borrowing and yield. And an operational overhead. There's not that much of operational overhead, but some amount, because lending effectively requires also dynamic risk parameter changes, especially because you have dynamic markets. If someone tells you something else, they haven't basically built a lending protocol and went through all the bear markets and market cycles to see all the things that might happen. So from that perspective, you need active management, and governance is the most resilient way to do that instead of a centralized party doing so or trusting a centralized some sort of asset manager. And when we think about these different deployments, so Aave is a very important infrastructure for every single network. And we notice that there's a lot of networks coming out, and they always default to actually getting the same DeFi protocols there and trying to grow their ecosystem with the same type of infrastructure. And that comes with a cost and a risk. And typically, to grow DeFi, you need to have a really DeFi-specific environment and utility for that. Arbitrum is a great example where DeFi has been growing significantly, and Aave is one of the biggest markets. But for these smaller ones, it comes with a cost. So if there is enough revenue for the Aave DAO to take that risk, there might be an argument that those networks doesn't need to have a Aave deployment, because when there's Aave brand, the users will trust Aave, and it needs to have that certain risk management there as well.
Stephen, the way I heard fragmentation come up when you were speaking is all of these different custom chains for all of these different institutions. One of Ethereum's big goals over the next like short to medium term is to have a unified Ethereum experience, which I would imagine would be, we want to be inclusive of Arbitrum. So how do we both provide institutions with all of the chains that they want without fragmenting into just all of the same kind of like patchwork silos of bank ledgers that we have in the current TradFi system?
Yeah, so I think the first thing is this realization that many institutions want their own chains. They want their own little dominion and environment that they can control, often for very, very good reasons. And as an entire Ethereum ecosystem, we need to recognize that, and recognize that if we want to win the institutions, we have to actually get around that and say the best way for Ethereum to win these institutions is via a layer 2 chain like an Arbitrum chain. Because if there are cracks in that internally, we're actually all going to lose, and we've seen this, right? It's like Tempo, Circle, Arc. They weren't choosing L2 or Ethereum. They were choosing, we're doing our custom chain. We're either going to be an Ethereum, and that means a layer 2, or we're actually going to be in our own layer 1. And unfortunately, they went for a layer 1, which I think is a mistake, that, to be quite honest. But the point is, everyone in Ethereum, whether you're a layer 1 maxi or layer 2 maxi, needs to understand that actually this is the way that Ethereum wins institutions, is via layer 2, and we need to celebrate that and get around to that. And the second thing we need to do is build good interop, which is like a buzzword today, to actually make this less fragmented. We're not going to have fewer chains. We'll just have to choose, do we want them in Ethereum or not? And assuming we do want them in Ethereum, we have to build good interop there. And my controversial take is there are a lot of people that will think that interop is solved on a whiteboard with deep protocols. And I'm a researcher by trade, so I'm offending myself, so I can say this, but that's completely, completely wrong. I would say that's like 10% of interop. 90% of interop is actually just getting the wallets to just abstract away the details. If I have Arb on Ape chain and I want to go to Ethereum, I have to like get Ape gas, and then I have to swap, and then I have to find the right path. It's a nightmare to do very simple things, and there's zero reason why wallets can't abstract that for you today in one click, say, hey, there's what you want to do. And there's an advanced button which you can like change the path and actually change some of the details. But I think it's all about wallet support, and that's what's going to get us deep interop that actually solves the fragmentation.
All right, Stephen putting all the responsibility on wallets.
Basically, yeah, not us. You does that.
But I have to agree. I think it's not really that much of an infrastructure problem. It's effectively having that experience layer, which is vaults and accounting, and then on the actual application level. And a lot of this abstraction can actually exist and is possible today. So I think that will happen over the next months.
Yeah, I would also contribute to this. I think that idea that you want to simplify everything to be hidden under the hood is understandable. But from other point of view, someone have to make decisions for you. I mean, if we would aggregate the same way as OneInch did aggregation, this is all happening atomically inside one transaction. So users are not really caring about which liquidity sources are being involved in this aggregation, what was the path, was it complex or not. They only care about exchange rate, was it good or not for them. But when we talk about cross-chain stuff, there are like a plenty of bridging solutions which have different properties. Some of them are fast, some of them provide good rates, some of them provide better security, and I'm not sure that there is like a way to automatically decide what's better for the user. So, I mean, users still have to give some input. What exactly is important for them right now? Are they bridging this because they need to have money as soon as possible and it's like under 1 minute solution? Or it's most of their total wealth, and they want to be it as safe as possible, or they want the better rate, because if they transfer like 10K, you can't understand this without additional context. So whenever solution comes to me as advisor to talk about them and about their architecture, I always advise them that they should not make those solutions for the users. They should probably highlight an options. What's the priority? It should be done fast, or with the best rate, or with the best safety security for them. So, yeah, I would also like everything to be hidden under the hood, but at the same time, users may wish something specific. So, yeah, this is a complex problem.
So at the end of 2025, I think the key themes of this panel so far have been KYC compliance, fragmentation, and customizability. Zooming forward 1 year, so it's now the end of 2026, in as few words as possible, leak all of your alpha and tell me about all of the keyword themes that we will be talking about at next year's panel. Steven, I'll start with you.
I think it's going to be more privacy institutions. Like we're seeing like the very, very early part of this, but I guess the other one that we're also kind of kept on this panel that I think is going to be increasingly true is just finance, right? The merging of, I don't think we'll continue talking about RWAs and DeFi as totally separate things.
Just A's and just finance?
A's and finance. But actually, like I've met a lot of people. I've met people, I say, what do you do? I work in DeFi. I've never once met someone that says, I work in centralized finance. Right? That doesn't happen. And the idea is we hold ourselves back by describing ourselves as doing something fringe. The reality is we're seeing DeFi being packaged up in institutional package today in DATs and ETFs. We're seeing traditional instruments being packaged up on chain. And the reality is this is a part of one system. And I think those will converge.
Anton.
Yeah, 1-inch plan is simple. We will make DeFi great again with all those stuff which we already announced and with all those stuff which we have in research. I think in collaboration with money markets, we will blow your mind.
Stani.
DeFi for everyone.
All right. Thanks, everyone. That's all the time we have today.